Something broke in the margin system, not the price, the mechanism itself. The infrastructure that's supposed to hold the paper market together just cracked for the second time in 72 hours. CME raised margins on January 28th. Gold, silver, platinum, palladium. The cost to hold positions doubled overnight. Traders scrambled, some survived, some didn't, and now, effective Monday morning, they're hiking again. Another 33% on gold, another 36% on silver, another 25% on platinum. Sequential increases, stacked on top of what already happened. The traders who survived the first hike by scraping together capital now need even more cash in 24 hours, on a weekend, when banks are closed. I am Kenao. Welcome to the vault. Today, the Asian opening tonight decides everything, and by the end, you'll know exactly which market breaks first. The official explanation is risk management, better coverage, standard procedure after volatility, but the timing screams something else. Friday, silver crashed 31%, the largest single-day loss on record. JP Morgan closed 633 short contracts at the exact bottom. Perfect timing, perfect exit. And 72 hours later, CME announces the second margin hike. This wasn't planned months ago. This is a reaction. Let me show you the mathematics. Before January 28th, holding one silver futures contract required roughly $25,000 in margin. After the first hike, $66,000. After Monday's hike, roughly $90,000 per contract. If you were holding 10 contracts, you went from needing $250,000 to needing $900,000. Where do you get $650,000 overnight on a weekend? You don't. Your broker liquidates automatically. That's exactly what happened Friday. Forced liquidation drove silver down 31% in a single session, the largest one-day drop in recorded history, bigger than 2008, bigger than COVID, bigger than 2011. This was systematic destruction of leveraged long positions, and JP Morgan was waiting at the bottom with buy orders ready. 633 contracts, closed at the exact low. That's 3.165 million ounces of silver. They knew the margin hike was coming. They positioned accordingly. And when maximum panic hit, they executed. And now, 72 hours later, CME is doing it again. JP Morgan already exited. They're flat now. The people getting forced out are retail traders, small hedge funds, family offices who believed in the silver thesis and leveraged up. This is where things stop making sense. But Monday is different from Friday. The physical market is dislocating from paper. Not just diverging, dislocating, complete separation. Two different realities, two different prices, and Monday's opening will test whether this disconnect can continue or whether one of these markets is forced to surrender. Bullion Star, one of the largest precious metals dealers in Asia, posted a trading update Saturday. It remains uncertain whether we will be able to acquire any additional silver inventory at all. Not expensive inventory, any inventory. They can't source physical silver at any price. Golden State Mint shut down silver sales. They've stopped taking orders entirely. Baird & Company, the UK's largest precious metals refiner, shut down online sales entirely. No explanation, no estimated return date. These aren't small operations. These are the institutions that supply the physical precious metals market, refiners with decades of history, wholesale distributors that move millions of ounces monthly, and they're tapping out. The last time this happened was March 2020, COVID panic. Mints shut down, supply chains froze, premiums exploded to 60%, 70% over spot. But that made sense. The world was shutting down. What's the reason now? The mines are operating, the refineries are running, so why can't dealers source metal? Because the physical silver is being absorbed faster than it's being produced. Industrial demand, Chinese buyers, Indian buyers, they're taking delivery, they're pulling metal out of the system, and it's not coming back. Bullion Star's statement continued. Throughout this period, dealers have witnessed extreme and unprecedented physical demand. At the same time, replenishment options have become increasingly scarce with physical metals drying up and mints operating under enormous backlogs. Sharp price declines in the paper markets are difficult to reconcile with the realities of the physical precious metals market. Let me translate. The paper market crashed 31% on Friday, but the physical market can't find metal to sell at any price. One of them is wrong, and the physical market is screaming that it's paper that's wrong. Look at the numbers. Shanghai spot, silver closed Friday at $122 per ounce. COMEX closed at $85. The premium is $37. That's a 43% premium for physical metal in China versus paper contracts in New York. If you're a trader with access to both markets, you should be able to buy silver in New York for $85 and sell it in Shanghai for $122. That's a $37 risk-free profit on every ounce. But the arbitrage isn't closing the gap. It's widening. Friday morning, the Shanghai premium was $28. Friday night, $37. Saturday morning in Asia, reports suggest it widened to $40. Why? Because you can't actually move the metal. When you buy a paper contract in New York, you're buying a promise, but the warehouse is running dry. The registered category is down to roughly 30 million ounces, claims on hundreds of millions outstanding. The paper market is fractional reserve. The ratio of paper claims to physical metal has been 100 to 1, sometimes 200 to 1. That works as long as nobody asks for delivery. But when buyers start standing for delivery, the system breaks, and it gets worse. On JD.com, China's largest e-commerce platform, physical silver bars are listed at $163 per ounce right now. Not $122, not $85, $163. That's a 91% premium to the COMEX paper price. Standard 1 kilogram bars, industrial grade. This doesn't happen by accident. Why would anyone pay $163 when the official price is $85? Because $85 is a fiction. It's a number generated by margin calls and forced liquidation. The Chinese buyers paying $163 aren't stupid. They're securing supply. Because at $85, you can't actually get the metal. Not in size. Not with guaranteed delivery. Not fast enough to keep production lines running. China produces roughly 112 million ounces of silver per year. But China consumes over 200 million ounces annually. Solar panels, electric vehicles, 5G infrastructure, semiconductors. They're running a structural deficit of nearly 90 million ounces every single year. They have to import to keep the factories running, and the imports are drying up. So when the paper price crashes, Chinese industrial buyers don't sell, they buy more. Because the alternative is shutting down production lines. A solar panel factory that goes dark loses millions per day. Paying a 91% premium to secure inventory is cheap insurance compared to that. The premium isn't irrational, it's survival. But Monday morning, the margin hike forces more paper traders to liquidate. The paper price could drop to $80, $75, maybe lower. While Shanghai stays at $122 and JD.com stays at $163. The disconnect becomes so extreme that one of these markets breaks. Monday's opening will tell us which one breaks first. This is where the system starts leaking, and the Asian markets open tonight, not Monday morning, tonight, hours from now. Shanghai Futures Exchange opens at 6 p.m. U.S. Eastern. Hong Kong follows. Tokyo, Singapore, they trade Sunday night U.S. time. They set the tone before New York wakes up. If Shanghai silver opens at $122 or higher, if it holds steady or rises, that's the signal. The physical market is not panicking. They're treating Friday's 31% crash as irrelevant noise. They're saying the real price is $122 and we're not budging. But if Shanghai gaps down hard tonight, if it drops to $110 or $100, that's a different signal. The forced selling is global. The liquidation pressure isn't contained. Asian traders are dumping too. The margin hikes are working worldwide. The next 12 hours will determine whether this disconnect continues or whether it resolves violently. And here's the complication. Bitcoin, it closed the weekend at $78,000. That's weak. And 78,000 isn't just a number. It's a threshold. If Bitcoin breaks lower Monday, the next stop is $74,000. And $74,000 is Michael Saylor's cost basis. MicroStrategy owns roughly 214,000 Bitcoin purchased at an average price around $74,000. If Bitcoin drops below that level, Saylor's entire position goes underwater. But it's worse. MicroStrategy isn't just holding Bitcoin, they're leveraged. They've issued $2.6 billion in convertible bonds to buy more. If Bitcoin drops below 74,000 and stays there, the conversion math breaks. The lenders start asking questions. The forced selling risk becomes real. Not just for MicroStrategy, for every institution that followed Saylor's playbook. And Bitcoin and silver have been correlated for months. The correlation coefficient has been running at 0.7 to 0.8. If Bitcoin breaks 74,000 on Monday, if crypto crashes, the liquidation cascade spreads. This is how systemic events unfold. One asset breaks, margin calls hit, forced selling spreads, everything sells. Friday was metals, Monday could be crypto, and if crypto breaks, metals get hit again, someone new. Then there's Iran. The Americans should know if they start a war. This time it will be a regional war. That's Ayatollah Khamenei, delivered Friday. The same day, silver crashed 31%. Trump has deployed additional carrier groups to the Middle East. Qatar's foreign minister traveled to Tehran and delivered what sources describe as a final message. The response was unambiguous. We will deliver a powerful blow to anyone who attacks. Rising tensions could be another catalyst. If tensions escalate overnight, safe haven flows could override everything. Gold rallies, silver rallies. The margin hikes don't matter. But here's the trap. In the initial phase of a geopolitical shock, everything sells first. Phase 1 is liquidation. Traders sell everything to raise cash. Then safe haven, buying kicks in. But that's phase 2. Monday might still be phase one, so we have three major forces converging Monday morning. The CME margin hike forcing 33% more capital on gold, 36% more on silver. Bitcoin sitting at 78,000, one bad day from breaking Saylor's cost basis. And Iran tensions that could explode or de-escalate. They didn't expect this move. The timing of the January 28th margin hike wasn't random. It came right after Kevin Warsh was picked as the next Fed chair. Markets sold off hard. Gold down, silver down. Dow futures dropped 300 points. Warsh tightening means less money printing. And 72 hours later, CME announced the first margin hike. Then Friday's 31% crash. Then this weekend, the second hike. The sequence suggests coordination. The Fed signals tightening. The exchanges raise margins. The banks exit their shorts at the bottom. But here's what the market missed about Warsh. He's not as bearish as the reaction suggested. Yes, he wants balance sheet discipline, but he's also dovish on interest rates. He's bullish on AI-driven productivity. He believes technology allows the economy to grow without triggering inflation. He wants rate cuts with balance sheet reduction. That policy mix creates short-term liquidity pressure, but it sets up for a powerful rally once the forced liquidation ends. Financial conditions are already loose. The Financial Conditions Index has dropped to 98.3, the lowest since early 2022. The Fed has cut rates by 175 basis points since September 2024. The dollar has fallen 12% over 12 months. This is the macro backdrop that supports higher asset prices once forced selling exhausts. So why did silver crash 31%? Because JP Morgan needed an exit. 633 contracts closed at the exact bottom Friday, the precise tick. That's 3.165 million ounces covered at the perfect price. The timing was surgical. They knew the margin hike was coming. They positioned accordingly. And when maximum panic hit, they executed. This is how suppression works. Drive the price down, create panic, force weak hands to sell, cover your shorts at the bottom. JP Morgan just ran that playbook in real time. They're out now, flat. And the second margin hike ensures the forced selling continues without them. But here's the problem for the banks. The physical market isn't cooperating. Silver has been green for 9 consecutive months, the longest winning streak in history. Gold has been green for 7 months, also the longest in history. Friday's 31% crash didn't break those trends. It was a single-day event driven by forced liquidation, not a fundamental shift. The bull market structure remains intact. And here's the historical pattern. Every time silver has traded at a 30% discount to fundamental value, it has bounced back within weeks. Fundamental value right now is estimated at roughly $130 per ounce. COMEX closed Friday at $85. That's a 35% discount. But timing matters. The question is whether Friday was the final flush or whether Monday brings one more leg down. The margin hike suggests they want one more leg. Force complete capitulation, clear the deck. But the physical scarcity suggests the floor is here. Dealers are shut down. Premiums are at 43% in Shanghai, 91% on JD.com. Mints are backed up for months. The physical market is saying $85 is too cheap. These two realities collide Monday morning. The paper market wants to go lower. The physical market refuses. Something has to give. And the Asian opening tonight will tell us which market blinks first. Shanghai futures open in hours. If Shanghai silver holds at $122 or rises, that's confirmation. The physical market is calling the paper market's bluff. Friday's crash was manufactured, forced liquidation, not real selling. But if Shanghai gaps down when it opens, if it falls to $110 or $100, that's a different message. The selling pressure is global. The liquidation isn't finished. Bitcoin needs to hold 78,000. If it breaks 74,000, Saylor goes red, crypto crashes, the correlation drags silver lower, Iran needs to stay diplomatic. Any military strike changes everything. But the initial reaction to conflict is always liquidation first, safe haven second. Monday opens with all these forces converging, the margin hike, the physical shortage, Bitcoin on the edge, Iran tensions, JP Morgan already out, dealers shut down, Shanghai at $122, JD.com at $163, COMEX at $85, 9 months of consecutive gains for silver, and a 31% crash on Friday that looks more like capitulation than the start of a bear market. One of these realities overwhelms the other Monday morning. Time is running out. But here's what won't change. The structural deficit, the industrial demand. China needs 200 million ounces annually and produces 112 million. That 90 million ounce deficit doesn't go away because COMEX raised margins. The solar panel factories don't stop needing silver. The EV manufacturers don't stop needing silver. The physical demand is inelastic. The dealers shutting down proves the scarcity is real. Bullion Star can't source metal. Golden State Mint can't secure supply. Baird shut down online sales. The above-ground inventories drain. The 43% Shanghai premium proves the demand is real. The 91% JD.com premium proves the panic is real. Chinese buyers paying $163 for metal that officially trades at $85 aren't making a mistake. They're securing strategic supply because the alternative is watching factories go dark. So the question is whether the paper market can continue to suppress the price. And the answer depends on leverage. As long as traders are leveraged, margin hikes can force liquidation. But if physical buyers absorb every sell-off, eventually the paper market runs out of ammunition. The shorts cover, the margin hikes stop working, and the price snapback becomes violent. We might be at that inflection point. Monday's opening will clarify the margin hike takes effect at Monday's open. Traders need to post the additional capital immediately or face automatic liquidation. And on a Monday morning after a weekend, liquidity is thin. Order books are sparse. If multiple traders are forced to liquidate simultaneously, the selling overwhelms the buy side, stop losses trigger, the cascade feeds on itself. That's the bear case. More forced liquidation. Bitcoin breaks 74,000, crypto crashes, metals follow, Iran escalates, everything sells. The disconnect with Shanghai widens to $50, $60. But here's the bull case. JP Morgan already covered. Large banks exited Friday. Short interest is lower. Physical holders refuse to sell. The dealers can't source metal because it's locked away. It's not coming back at $85. The physical scarcity creates a floor. Every sell-off gets absorbed. The Shanghai premium holds at 43%. The JD.com premium holds at 91%. The message is clear. $85 is fake. The real price is somewhere between $120 and $165. The CME margin hike might be the last desperate move. After this, if physical demand doesn't break, if premiums don't collapse, the paper pricing system loses all credibility. Shanghai becomes the global price setter. Monday could be that inflection point. Or Monday could be one more flush before the turn. If this continues, the price won't be the real problem. The real problem will be that you can't get the metal at any price. The system is already showing cracks. Dealers shutting down, premiums exploding, arbitrage failing. Monday's opening decides whether that divorce becomes permanent. Shanghai opens tonight. Bitcoin trades overnight. Iran could escalate any moment. The margin hike takes effect at Monday's bell. And somewhere in those 12 hours between now and Monday morning, the direction becomes clear. By the time the headlines admit it, it will already be too late.